future trends, deep insights, industry leaders. This is the iGaming Next podcast with your host, Pierre Lindh.
This podcast is brought to you by Pragmatic Solutions, the leading iGaming PAM platform with a modular approach, including many benefits like a fast, secure, and scalable API-based platform, integrated with all major third-party products and services. Make sure you head over to Pragmatic Solutions and join our smart thinking.
And Julian Buhagiar, nice to have you back here on the podcast from RB Capital. For once again, we're going to do what we started out a couple of months ago here, a summary of the Scandinavian quarterly reports that came out today. How are you doing today, Julian?
I'm good. Good to be back on this podcast. Good to speak with you as well, Pierre. It's this week is always the interesting week, right? It's the earnings report week. So you get to see a lot of movements and shakers. This week in particular is interesting, right? With the proposed announcement of Twitter takeover, right, by Elon Musk, which essentially has sent a lot of markets into various directions. And I think because of that, we're also seeing some very interesting movements in the gambling stocks as well.
Absolutely, Julian, and not only Twitter, but I believe Meta also, as in Facebook, released some numbers here yesterday, and that were quite positive. Actually, with that, I guess to give some tailwind to the tech industry in general here as well. I believe as well.
I think the Meta results are actually quite interesting because revenues are actually down for Meta, but user acquisition is up, and because of that, the share price has actually been quite favorable. Right, investors have actually seen that as good news, which actually is funny. So for the FANG stocks, it's less about revenues, but more about eyeballs, which is absolutely contrary to that in the gaming industry. Gaming industry is all about revenues and distributed revenues, as we can see from the stock earnings this week.
Absolutely. And so today what we're going to discuss is, of course, the 4 Scandinavian quarterly report that came out from the very traditional Scandinavian gambling brands that are Evolution, Betsson, Kindred, and Kambi. So it's always interesting in the reporting season that these 4 companies tends to report at the same time. And obviously from being Scandinavian myself, for me, I put an extra little eye into these 4 organizations. So, why don't we jump into it straight away here, Julian? And if we take them one by one, we can start with Evolution. I mean, I suppose the story of Evolution is, people expecting a slowdown, as they do before every quarterly report, because the sentiment with Evolution is always, when are they going to reach the ceiling in the live segment? As in, like, when will they stop finding new growth in that segment? And for years and years, this has been the sentiment. And obviously, we've seen a drawback in the stock price in the last quarter. But when people think that Evo is down, they come back even stronger. And I would say, as a short summary of the report, this is an incredibly strong report from strength to strength. There's absolutely no slowdown that we can see in this report, and it's just it just showcases the resilience of Evolution despite all the macroeconomic factors that are taking place all around the world at the moment. What's your summary here, Julian?
I think that's right. Evolution earnings reports are always about managing expectations. This one has been particularly good because they are effectively building a story that the Asian revenues are growing. There's a strong growth there, but especially live casino as well. Now, there's a few obviously notes that you'd need to kind of read between the lines, and ultimately will depend on how Evo kind of grows, not just on a quarter by quarter basis, but also on a product diversification basis. So let's mention the good things, right? Obviously, Asia has been the strongest growth. I think it's almost doubled, right? I think it's about 94-95% growth. The US has also been particularly strong, right, quarter on quarter, and importantly, there's been a lot of good vibes around the revenue, the overall revenue, and the EBITDA, right? Live casinos up 43, I think 44%. So I think top line numbers are good. The one flag at the moment seems to be the relatively flat RNG growth. It's essentially been flat over the last quarter, and it's been a challenge. In fact, even Evolution themselves have said the success will not be straight lined, which means there needs to be some more either product or even strategic diversification to be able to get to that kind of diversification on product growth. I think the market seems to have responded reasonably well. I mean, earnings have locked in a good 5% on share prices this morning since the announcement. They'll probably go up a little bit more, knowing how the gradual tail off on sentiment and investor momentum seems to go. What's also interesting to notice right now, out of the majority of the Swedish stocks, Evolution is trading at one of the highest PE ratios, right? Which, depending on who you talk to, means some things or not. But currently, it's about, I think the price earnings ratio is in excess of 30. Right, and if you compare that to, say, Meta, I think trades between 12 to 15 price on earnings, and I think Alphabet, which essentially is the parent company of Google, is about 20. And if you look at some other gambling stocks, which we'll go into later on here, they also do trade at a lower PE ratio, which might suggest that currently the Evo share price might be slightly overvalued compared with its competitors. However, revenues and EBITDA seem to be strong. They continue to grow, more importantly. So anybody looking to get a good return on investment should be quite happy with the report they received today.
Yeah, absolutely. I mean, in regards to the PE ratio, it's a discussion that has been taken over and over amongst investors, both on the public space here and behind the scenes as well. But I mean, publishing an EBITDA result of plus 43% year on year against very tough comparables of 2021 Q1 earnings, where it was a great quarter for Evolution, and so to outcompete that quarter and still show 43% growth year on year in EBITDA, and the EBITDA growth that they have shown consistently from quarter to quarter over the last years suggests that the future is still ahead of Evolution, right? And that would be the reason why the PE ratio is higher than the average stock listed company.
Yeah, I think that's right. On numbers alone, right? Assuming current trajectory, it would be safe to say that at least from a trajectory perspective, the peak hasn't yet been reached. Obviously, as we know in stock markets, and especially with US verticals as well, there always seems to be more challenges that you'd face with regulation heading out, the state by state legislation going. How's the competition dealing with Evolution as well? But I think on numbers, they seem to be healthy, they seem to be good. There's one slight flag on, like I said, on RNG revenue, product breakdown, but it seems to be more of a product diversification challenge rather than one of revenue, if that makes sense.
Yeah, absolutely. It does make sense, and if it is, we should scrutinize and try to understand what is possibly the headwinds for Evolution in all this positivity. And it is, as you point out, it is the RNG segment which actually is publishing less revenue in the quarter than the quarter before. Here at 62.3 million euro revenue in Q1 compared to 62.9 million euro. So relatively flat, but still a minor decrease. Now, that's I suppose is the negative news. And if we are to believe from the investment call as well, we should forget essentially a couple of quarters on the RNG segment. Evolution is not expecting the RNG segment to grow in the next couple of quarters either. Potentially because players are bleeding over to the live segment, so they are kind of cannibalizing themselves to some extent. That just speaks volumes again on the fact that the live segment is continuing to grow and it becomes more and more popular. Not just that new players enter the casino space, but also because the traditional RNG players are moving over to the live segment as technology progresses, broadbands become stronger, and internet connectivity becomes better and better, and so on and so forth. So I think that's something that's interesting as well to follow on that segment. And my question is a bit as well what Evolution will do as they go forward in terms of their M&A strategy. If they haven't yet figured out how to grow their RNG segment, the question is like, are they ever reoccurring? Like, are Evolution going to enter new verticals? Are they going to just stay laser focused on the live segment, what they do best, and just continue to showcase exponential growth in that vertical to essentially continue to build revenue within that one vertical? That is the question that we still have ahead of us here, because Evolution hasn't really done any major moves since the acquisition of Big Time Gaming last year. And the question is, what will come next for Evolution?
Well, I think it's a very good point, and there's a number of points you've outlined that we should probably unpick specifically to Evolution. The first one is the most recent one around M&A, right? And acquiring any company, especially a studio with product, is always going to be challenging. How do you integrate it into your overall portfolio? How can you push that seamlessly to the rest of your sales force? And importantly, how can you maintain a very consistent team, happy across the different verticals, which essentially seem to be growing? I think Evolution's main focus right now doesn't seem to be M&A. It seems to be more about revenue diversification. I think this is why the report made a lot of emphasis around two things: primarily Asia, more than the US, right? If you just take the cues from the earnings report, but especially also around live casino, right? So which I guess leads to the second point: how much traffic from RNG, right, has essentially migrated over to live casino, and importantly, is that still on a growth trajectory? And I guess that's something we will find out over the coming quarters, just to understand how that performance specifically evolves over this year, and most likely also next year as well. I think on the Asian traffic, it's also very important as well. It would be good to get a breakdown of where specifically those territories are performing, and importantly, how diverse is that traffic, right? And understanding how sustainable this is down the line. US, we know obviously is slow, but at least we know is distributed, right? As the states gradually grow out, you can actually get to see some more stable distributed revenue, which I guess would be more appeasing to investors looking for long-term growth and importantly long-term stability. So I think in terms of just to kind of have the elevator pitch on Evolution at the moment, it's been a very good earnings report. I think it's made a lot of shareholders very, very happy. I think the price has already been factored into the overall share price. We haven't seen some massive boosts in overall share value, but I think that is fine for a gambling stock. It's better to go in that direction, as I'm sure you'll agree.
Absolutely, and I think also the shareholders are trying to figure out where to price the stock, because just looking at the numbers in the last couple of quarterly reports, it's been a very steady exponential growth in the organization. However, the share price has been wildly jumping up and down, especially in the last 4 or 5 months or so. And so I suppose the shareholders are trying to figure out for how long can they keep this kind of exponential growth in revenue. So that'll be interesting. But one other note I took as well from this quarterly report is the fact that the EBITDA margin is obviously incredibly strong. I mean, they are again above 70% EBITDA margin, and they forecast that this EBITDA margin will remain at between 69 and 71% throughout the course of the year. And we shouldn't forget that we are moving through a very uncertain times at the moment from a macroeconomic factor. Rampant inflation. We don't know, exactly where the inflation is going to take us. Obviously, there's a war that is raging at the moment, and we shouldn't forget that the pandemic is although we don't speak about it that much, it's still ongoing, and Evolution is still steadfast in committing themselves to a 69 to 71% margin for the rest of the year. I just thought that was it showcases confidence, I think, as well in the from the leadership.
Yeah. I think that's right, and profit margins, specifically in gaming, are important because they show a good level of cash resilience should there need to be any changes in direction or indeed strategy. If a company is pulling more than 50% profit margins, it essentially means it can change direction of the ship reasonably quickly to adjust to real world concerns. And I think this is one of the signals that the Evolution report wants to send to its investors, particularly because there's an ongoing pandemic, which China has now reiterated its zero COVID policy, which essentially means that certain markets can or cannot be affected. But it also means that should Evolution decide to go down a specific target market or a specific target product, it not only has the cash reserves, but also the operational excellence to do so. And that actually does signal confidence, not just in the short term, but also in the medium term for any would-be investor.
Absolutely, Julian. Interesting. I'm looking forward to see the next quarterly report, as per always here. And with Evolution, it's funny, they don't mention all-time highs in the quarterly report because it just happens every single report. It's a given by now. But yes, nonetheless, let's see how this is all going to play out. What do you say, Julian? Shall we move over to the next quarterly report, which is Betsson Group? What's your key takeaways here from the Betsson report?
So this is funny, but I actually like Betsson more than I do Evolution from an investor's perspective, because Betsson has much more distributed revenue. It might not necessarily be both. It might not necessarily be boasting significantly better revenues in any one vertical, but they have very solid distributed pipeline and importantly top line numbers. And from an investor, that's always more reassuring, right? Because you effectively mean that you're not just growing the business based on one or two specific strategies. You are growing it on a number. So let's just unpick Betsson's numbers so far, right? Their EBITDA might be down, right? It's down quarter on quarter, but revenues are strong, right? Their LATAM business has particularly done well, right? I think 20% of their overall group revenues actually do come from Latin America, and also this is important when we then move to Kindred, right? The Nordic balance, right, is actually quite healthy for a Swedish company, right? I think it's around the 40-45% mark in terms of their overall percentage of revenues, and importantly, they're also not overtly committed in the US. So if you really take into account the overall global distribution of what essentially is a global brand like Betsson, it's actually looking quite healthy. And the one final note, which I particularly like, even though the share price is up today, right, which means that it's been received well by the market. I think it's about 7 or 8%, right? The PE ratio is actually cheaper than Evolution, which actually means it would send a good buy signal, right, to any would-be analyst looking to take a long-term trajectory.
Yeah, no, that's definitely the case in the PE ratio. I think Betsson is trading at a PE ratio of below 8, something along those lines. I think when we tell the story of Betsson, it's really like, as a comparison, it's really important to understand Kindred, which is also an organization we're going to cover, because it's two Swedish operators coming from a very traditional Scandinavian past that are trying to diversify the revenue in order to not be at the mercy of very quick regulatory changes, essentially. But how they execute that strategy is totally different. And so when we talk about Betsson and Kindred, I think it's really important to bring up some comparable numbers. And so, for example, Betsson derives 36% of their revenue from locally regulated markets, whereas Kindred is deriving 77% of the revenue from locally regulated markets at this stage, right? So Kindred is trying to approach the strategy similarly to how the big giant operators do. They want to focus on locally regulated markets, generate more sustainable long-term revenue. But the problem with that strategy is, of course, that when they go after territories like the North American market, which is an emerging market from a regulatory point of view, it's not necessarily a straightforward strategy that will always succeed. And whereas Betsson, if we just stay on Betsson as a topic, they have just said that we are going to continue on this kind of .com MGA licensed strategy, where they are entering territories. They are entering great territories, and they are not scared of establishing themselves in great territories, while also hoping that they will regulate one day. And so the difference between Kambi and Betsson in their diversification efforts is that Kindred focused their investment into the US, whereas Betsson focused their investment into Latin America. And now the story is becoming clear on who is the winner and loser here in the diversification. Because as you pointed out here, Julian, 22% of Betsson's group revenue is now deriving from Latin America. What does that mean on a year-to-year basis? Well, Betsson is increasing the Latin America revenue on a quarter-by-quarter basis by 174%. Right? So they are wildly successful in their diversification of revenue. And this now means that between the Nordics and the UK, which are the traditional markets for Betsson Group, they now derive 45% of revenue from those two markets, if you will. So Nordics and the UK. But those two markets obviously are potentially dangerous markets, because we have the UK Gambling Commission's report coming now in spring or in summer, that's going to outline potential stricter regulation towards the operators. And we're also at the mercy of the Swedish regulator, who has already said that we will see tougher regulation at some point as well, right? And so Betsson is trying to diversify away from being dependent on these two markets, and they've been successful in that. And obviously the investors are reacting really positively to this quarterly report for that very reason. Even though the EBITDA is lower, the diversification efforts are working for Betsson, which has not been
best example of this.
Kindred.
No, best example of this is the Dutch and the German markets, right? So Betsson, like many other operators, had to pull out, right? But the casino revenues only dropped by about 5%, right? So you can see the benefits of having a distributed revenue strategy, right? As long as you can target a number of different territories globally, and not to be too dependent on the color of those markets, but also on the type of strategy you pursue in terms of the acquisition, right? Which is contrary to what a lot of US focused operators are doing. Then should for whatever reason that strategy not work in that one market, then the impact will be relatively low compared to others who kind of bet the farm, so to speak.
Yeah, absolutely. And Betsson is a funny company. They are chipping away. They are doing their thing. They don't have any kind of global takeover ambitions to become the biggest operator in the world. They are being realistic. They want to outcompete the market in the markets where they are active, and that's it. They want to publish good results, and they aren't going ahead of themselves. They don't have these massive plans. They are doing their thing. They are chipping away, and that's always been the story of Betsson.
Yeah, as an investor, I like that. I like Betsson. They effectively become understated, right? Undervalued, right? And at some point, you never know. Somebody might make a very good, hard to refuse takeover bid, maybe as early as this year. You never know.
Exactly. And so jumping over to to Kindred here, then, Julia, if you will. It is a little bit the opposite story to some extent. I would say. I mean, the report is really it's an ugly report if you just look at the numbers. Now, saying that, it was not a surprise, right? Because Kindred they published a profit warning. They issued a profit warning about a month ago. Investors knew that the report was not going to be particularly great, so to say, but still, there's a 30% decrease in revenue year on year. There's a 77% decrease of underlying EBITDA, down to 24.5 million British pounds with a 10% margin, and they have decreased 24% number of active customers on a year-to-year basis. And so essentially, in every way you turn this report, there is not much positivity to find here. Henrik Tjärnström, the CEO, he does talk about the fact that they have increased revenue significantly in territories like Australia. But if we look at the statements of Kindred, where they talk about the North American market being the most important growth market for Kindred, we can see that they have decreased revenue in the North American markets by 26% on a quarter-to-quarter basis, and they actually they decreased the revenue by something like 15% in the North American market from the last quarter as well. And so we are seeing a steady decline in the North American market revenue, which is not that significant. It's just they don't publish exactly what the total group revenue is in comparison. They say that it's under other, which is 6% of total revenue. But the story doesn't look particularly great at the moment for Kindred. Julian, what's your thoughts here?
It's funny because I think Kindred have done a very good job of managing bad news to such an extent that this morning, if you look at the share price dropped at one point by 10% and has since almost recovered. So the intraday trading actually looks volatile, but the longer term projection isn't. And actually, I think that's thanks to Kindred managing bad news in a gradual fashion, just to ensure that this is going to be a marathon, not a sprint. In fact, if you look at the Kindred's earnings report, the first sentence is "strong headwinds continue, but optimism remains." And I think that is the prevailing morale, I guess, inside Kindred HQ right now. Let's be clear. Why are revenues down? The revenues are also down because of the withdrawal from the Dutch market. That has hit them hard, right? Particularly because obviously it has been a big focus for the group. I also think that they've made a big statement around reducing the share of gross winnings from what they call high risk players, right? And even if the actual numbers themselves are insignificant, the optics are reasonably good, right? So they would probably have taken a big hit in terms of their obviously top line, but especially their EBITDA. But because they released an interim report a few weeks ago, right, to kind of weather the storm, but also manage expectations, I think the corresponding market reaction has been tempered. And to that extent, I mean, they're trading at about 5 PE ratio right now. I mean, obviously, share prices are down 20% since the announcement from last month, but there hasn't been any significant volatility since then. It's kind of been a gradual slope downwards. And I guess that's actually what the team wants right now, to ensure that it's almost like a bear with us whilst we get this fixed, and we hope to be reporting better news over the subsequent quarters, if that makes sense.
Yes, absolutely. And, you know, the story of Kindred is, and in comparison to Betsson, we talked about that Betsson is a quite conservative company. They tend to not make any major moves or major commitments. And Kindred, on the opposite side of the fence, have been very aggressive in their ambitions. Yes. They want to invest heavily into the United States in the hopes that they'll establish themselves there and further down the line generate a significant amount of their EBITDA from that market. They are embracing this trend of vertical integration with the announcement that they are building their own sportsbook. Last year they acquired Relax Gaming as their kind of in-house game production studio in order to control the tech basically within the company. And this is typically moves that tier one, the major operators make in order to secure the future and to secure better margins and lower the risk in the company essentially. And so Kindred is essentially a small player with ambitions to be a big player, but they are taking risk in order to get to that point. And the question is now, when the emerging markets are seemingly not working out that well for Kindred, obviously 35% of the EBITDA derived from the Netherlands market that disappeared overnight, and it's not clear how long it's going to take for Kindred, if ever, to recover that type of EBITDA. And so the question is, where is the growth going to come from?
It's a high risk strategy, or at least let's call it medium risk, just to temper any concerns. If you go back to last year, right, when Kindred announced the Relax takeover, but also their US strategy, they made a very big "go big or go home" statement, right, to the world and to investors, to show that they were tier one forces to be reckoned with. Now that kind of message and indeed that kind of strategy comes with a high degree of risk, right? A dependency on markets such as the US and Netherlands, but also the ability to drive Relax, right, and to even higher profit margins and returns than they had previously done. So far, some things have worked against them. They've been mainly macroeconomic events, nothing particular that Kindred has done wrong, right? But I think if we just then look at the Betsson playbook, right, and what Betsson have really done well is they've always adopted a cautious revenue diversification approach and not necessarily make a big statement about it, right? And Kindred actually seem to be this year adjusting themselves to hopefully follow that fashion. Now, interesting enough, right? The price earnings ratio is arguably one of the most valuable and undervalued stock out of the four we've mentioned and we're going to mention today. So it would seem that from a speculator's perspective, right, one to buy might indeed be Kindred, particularly because if they are pragmatic about weathering the storm and can diversify their revenues to an extent that Betsson have done, then maybe we can see some very favorable earnings coming over the subsequent quarters. I'm not sure if you agree with that, Pierre.
Absolutely, Julian. And yeah, we talk a lot about the diversification in the revenue, and we mentioned here before that Betsson, let me see so I get this right. Betsson, they derive 45% of the revenue from the Nordics and from the UK at this stage. And compare that to Kindred, which derives 85% of the revenue from these very volatile markets, which are the UK and the Nordics, where Kindred essentially are at the mercy of regulatory decisions in those markets, right? Yes. And in this quarter, it was some favorable, funnily enough, regulatory decisions that were taken in Sweden, where the Swedes decided to lift these temporary restrictions that were imposed due to COVID, and so they were able to generate more revenues from those markets in this quarter. But so obviously Kindred are very, very strong in the Nordics and in the UK, and we shouldn't forget that they do derive a lot of revenue from those markets. And so looking forward into the future, the question that they need to resolve within Kindred, I suppose, is which markets are they going to grow in as they move forward into the future. The US doesn't seem to be working out for Kindred at this very moment, but can they invest and find other markets that potentially could help them to diversify these revenues? That's going to be the question. I'm hoping that Relax could help them, right, in this regard, and this is where hopefully a diversified product offering and a diversified portfolio can actually help Kindred deleverage itself of problematic markets like the UK and Nordics, right?
and it's again just understanding how the overall product portfolios work, right, in developing markets such as LATAM, but especially Asia, right, where we know that companies like Evolution and Betsson have thrived successfully, right, will be a key towards the diversification, but ultimately the commercial success of Kindred. I'm cautiously optimistic about Kindred, even though the results aren't necessarily that favorable. I think they fully understand what needs to be done, and hopefully we'll see some changes, both in terms of their strategy, but also in terms of their narrative over the coming weeks and months that will hopefully get to that effect.
Absolutely, and it's like what we have talked about before here on the podcast. Kindred is known for having a very strong leadership team, and so if anyone can turn around the ship, it is Kindred at the end of the day. And so we should definitely not discard them. And they are still a very cash generative business at trading
and
at
good value for money.
So definitely one to watch. Good value for money. So jumping into the last report here of the Scandinavian earnings week, let's say, which is Kambi, another Swedish classic here. Obviously, Kambi is a B2B provider building a sportsbook. They had a very big rise after the pandemic in 2020, peaked at some point in last summer. Before they have lost quite a significant amount of share value. They've lost, I think, around 65% of their share value since the peak of the last year's uptick in share value. And the reason for that is that shareholders are scared that the trend of vertical integration amongst tier one operators is going to significantly cause harm to Kambi. So rather than Kambi having strong competition, the worst competitor seems to be the in-house teams in
anyone and everyone that's full
want
stack.
To control their own technology, essentially.
Yes. So looking at Kambi's earnings report, right, which was released a few days ago, the share price is, I think, down 8% on news. But if you really look at then the last month, it's actually down 25%. And then there's a reason for this, right? There's been a few factors, particularly the DraftKings migration, right, which was expected to be around, I think, about 40% of their overall revenues at one point. But I guess also there's the news that Kindred is set to leave Kambi in 2026. And this is one of the challenges with being in the US, where the US values full stack or fully vertically integrated businesses, because it obviously places a very high value on tech and tech's ability to drive revenues and value. The challenge now will be how Kambi can diversify from what essentially has been initially DraftKings revenue, but I guess in the medium term also Kindred revenue as well. And that would need to be the biggest challenge for Kambi over the next not just few quarters but few years. That said, once you take DraftKings away, turnover seems to be ahead, as the earnings report stresses to emphasize, right? The turnover is ahead by 25% when you factor away the DraftKings revenue, and that's because of new US states, right? Such as New York, but also in Netherlands, right? So they've got a new partner on, and expect to hopefully be able to diversify. This is where we go back to the Betsson approach. Hopefully, have a more diversified revenue strategy in the coming quarters and years, if that makes sense.
Yeah, absolutely, Julian. And you mentioned here the focus on the North American market, on the Americans' pursuit of vertical integration here. And something that came out of this quarterly report that is interesting to me is the fact that Kambi is now starting to warm up to the idea of a more modular approach in their services. So traditionally, Kambi has been a kind of turnkey solution, take it or leave it, so to say, in the sportsbook. But they are now realizing that for them to be able to work with the tier one operators, especially in the North American market, they have to be more modular and flexible in order to have an in, so to say, with the tier one operators. And this is something that they talk a lot about in the quarterly report. And it's a strategic change, basically, for Kambi. They are waking up to this reality of vertical integration. And I thought that was quite interesting to read about as well. Just as a note to ICE here the other week, the biggest iGaming conference of the week, is that Kambi talks a lot. They are very open to have this debate around vertical integration and why it is not so
always the best,
clear
best
that
practice.
is the best strategy for the tier one operators, and they are being as vocal as they can here, because this is a trend that is kind of assumed by the tier one operators in the North American market, but it's still an unproven tactic, basically.
I appreciate Kambi's stance on this, and you obviously have some degree of empathy for them, because obviously that is their main business case, and they do have to make a very strong, compelling case for that. But then you need to be aware that they are up against a cultural competitor as opposed to actually a business competitor as well. America has always loved full stack, and particularly having technology as an own proprietary, own IP, owned motor inside a well-oiled machine. It's part of the American dream, and if they can actually associate that with long-term value, as what most blue chip companies in the US have, then Kambi is up against not just a competitive mindset, but a cultural mindset as well, which is difficult to change. This is why revenue diversification is important. If you are just a tech provider to a number of B2B players in the global scene, and hats off to Kambi, they do put up a good fight on trying to educate the market, right? Why diversification on a tech stack is important, and why you can't just bet the farm on a single tech play. And it remains to be seen whether this education process will ultimately lead to a better understanding of tech diversification, as I'm sure you'll agree.
Yeah, absolutely. And it'll be interesting to see how this is going to play out, because something Kambi also talked about is the operational excellence and how the product was in this large influx of traffic during the what's it called? During the Super Bowl. The product was still remained stable. It didn't crash. It was able to service its players, so to say, which was not the case for certain other operators and products, essentially. So that would be the kind of the case for using a third party like Kambi, is the fact that they just have so much more resources, in-house knowledge and focus on building excellence within their sports betting product.
Yeah, it's a tech challenge, and SBTech went through this similarly, right? Whilst they were still an independent entity. When you're a tech company, you also need to prove that your tech is integratable across a number of different providers and a number of different scenarios, right? Whereas if you're an operator with a full stack, right, a vertically integrated set of solutions, you don't really need to worry about third parties, right? Because you just have the one problem to deal with. So tech-only companies, right, are easier to build in terms of capitalization and go-to-market, but then proving the case in terms of how interoperable they are across the various aspects of an addressable market is always going to be a bigger challenge, particularly more so in the US. That always goes against this mentality of having just tech-only companies and just having kind of vertically integrated environments, if that makes sense.
Yes, absolutely. And, this from one thing to the other, something else that I noted in the quarterly report that I think is interesting for the Q2 and Q3 story of Kambi is I want to understand better how exposed they are in the US market at the moment, because they mentioned, for example, that they have brought 11 new partners live during Q1, all of which are North American partners. And they talk as well about the fact that the three biggest sports within Kambi is American football, basketball, and soccer. But they don't publish the geographical split in revenue in the quarterly report, so we can't see black and white where the revenue is derived from. But what this alludes to is the fact that Kambi is very exposed against the North American market, and being a pure sports betting organization, we should not underestimate the seasonality in American sports, where the NFL is by far the biggest sports league in the US, followed by the NFL. Also the college sports as well. With obviously we had March Madness behind us now in the on the basketball college season that always takes place in March, which is a massive betting event. And so the fact that we had Super Bowl as well in the quarter and March Madness is something that is very positive for the quarter. But it also means that the following quarter might suffer in the absence of these major sporting activities.
Well, this is one of those things that won't be necessarily revealed until the end of the quarter, right? We don't know what the product split is, but we will find out, right? Because as we're speaking now, the NFL season is over, NBA is soon over as well, right? So. Yes. So understanding exactly, right, once the curtains are pulled, actually what Kambi's Q2 numbers are will give us an understanding of what their dominance is in particularly NFL and NBA. Again, it goes down to product diversification. If you're going to bet the farm on the States, then that better be kind of a full calendar of sporting products you can support, right, to ensure that you have a reasonable percentage of the calendar year occupied in terms of revenue, if that makes sense.
Yes. And as a final note as well, from my end at least, from Kambi, is the fact that they now have agreed with Kindred to be able to pay back this convertible bond, essentially that has been locking. Let's say that has been putting Kambi in a bit of a handcuff behind Kindred's decisions here. Essentially, Kambi will now be free to pursue whatever strategy they like by paying back this 7.5 million euro bond. Obviously, I suppose the downside is the fact that Kindred is planning to leave Kambi by launching their own sportsbook somewhere along the lines of 2026. And Kindred is the biggest client of Kambi. So this is obviously a worrying moment and something for shareholders to be aware of. But the fact that they have been able to agree with Kindred to pay back the convertible bond means as well that maybe there's a sale coming. Who knows? Kambi is up for sale now.
This is my sentiment, right? If you look at the optics around the Kindred Kambi agreement, right, about the bond repayment, but also when Kindred will leave, right, in 2026, that's a reasonable amount of buffer, right, for Kambi to find an alternate strategy, whether it's revenue diversification or potentially a liquidity event as well, right? So for speculators, this might very well be an M&A opportunity, right? In the medium term, doesn't even need to be in the short term, right? By which time Kambi's revenue might have actually been done a bets on, right? Being able to be reasonably diversified as to allow a higher multiple in terms of their last 12 months, but as well as their future earnings, if that makes sense.
Yeah, absolutely. So interesting as well. There's a lot of interesting factors at play in these four companies that will determine their futures here. So it's definitely worth to keep an eye on all four of them and the development in this organization. The future quarters will be highly interesting as well. We are moving through very strange times, Julian, in general, from macroeconomic climates, like what's going to happen with inflation, what's going to happen, with the war that is still accelerating and how that's going to affect us all, on a macro scale, and what's going to happen, how will the inflation affect the iGaming industry. There's so many different variables at the moment for us to keep an eye on.
I think that's right. And honestly speaking, this is actually one of the most interesting quarters to be existing in, right? Because there's been so many factors, right, from a number of different levels, right, that you just don't know what not only the markets but the geopolitical stage will throw at you. I guess if you're somebody who watches stocks every day, it's a very stressful time. If you're unfortunate
that's it always,
enough,
I think.
well, that's always the day trading rules, right? I mean, there's a number of different stressful factors, right? If you are unfortunately involved, right, on the periphery of global warfare as well, that is also an issue. But I guess if you're trying to understand where your pension pot will ultimately derive from, and looking at what the best return on investment is, and should gambling form a significant part of that, I guess it's a very interesting time to be involved.
Absolutely, it is, Julian. And after this call, because it can be very stressful to keep an eye on the movements of the stock markets. Is it going to be a red candlestick? Is it going to be a green candlestick? It's can tend to increase the blood pressure a bit. So you know what? I'm going to shut off my stock trading app here for
always a good idea.
a couple of hours. Take a deep breath and continue to do some good work here. But Julian, it's been really great to have you back here on the podcast, speaking about these 4 quarterly reports. It's been hopefully we brought a little bit more insight to the audience here. But I think the story, all in all, is that the iGaming industry, I think we are a very resilient industry, and the evolution especially is showing the resiliency of the industry.
Yes.
And the fact that it can keep growing the way it does. We see other headwinds in certain markets, but overall, I think the iGaming industry is a very strong investment opportunity right now, especially in the recent downturn that has put the stocks at a discount.
Absolutely.
So, if you agree with that sentiment, Julian, we'll start wrapping up, and I will see you actually a bit later as well. We have another meeting to attend here, so
busy day for everyone.
Brilliant. Yes. All right, Julian. So thank you so much, and for those who listen in, thank you guys as well. Have a great rest of the day, and we'll see you here in the next episode. All right. Thank you so much.
Bye.